Today I would like to analyze Adobe, one of the largest software companies in the world. If we're going to take a look at the stock price, we can see in not many months we are down close to 40%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a huge market cap of 153.8 billion US dollar. This makes Adobe the 11th largest software company in the world by the market capitalization. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So we can see here in 2020, the revenue was around 12.8 billion US dollar. This was a 15% growth from 2019, so a very good growth. Then in 2021, we had the growth around 22%. This is something we like to see. In 2022, around 11%. And then in 2023 around 10%, and then again 2024 around 11%. So overall, I think we had a great growth in the revenue in the last 5 years, so as a check here. The next thing you're looking for is free cash flow growth in the last 5 years, a very important number because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 5.3 billion US dollar. This was a 31% growth from 2019, so very strong growth. Then in 2021, we had the strong growth again, around 29%. Then in 2022, we had the decent growth around 7%. And then in 2023, we had the decline around 6%. So this is something we don't really like to see. But then again, 2024, we had the growth around 13%. So the check here, we had a very strong growth in the last 5 years. So it's something we like to see. If we take a look here, we can see in 2023, the operating income increased, but we had a free cash flow decline. So I think the reason for that is Adobe wanted to buy the company Figma, but this got canceled and then they had to pay a cancellation fee around 1 billion US dollar. So I think this affected the free cash flow, but didn't affect the operating income. So I think if this didn't happen, then we would have a free cash flow grow also in 2023. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So what we're going to do now, we're going to take the free cash flow from 2024. So this is around 7.87 billion. Then we're going to divide it with the current market capitalization, 153.8 billion. So then we're going to get the free cash flow yield for 2024. So the number we get would be around 5.11%. So this is a great number, I would say. It's over 4%, so we like to see that, and this would be a check here. And I also think this could be an indication for undervaluation right now, because probably this company can increase the free cash flow in the future as well. So I think we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025 the free cash flow could be around 9.3 billion US dollar. In 2026 around 10.2 billion US dollar. In 2027 around 11 billion US dollar. So I'm not sure if these assumptions are a little bit too high. So let's just assume in 2027 the free cash flow could be around 10 billion US dollar. So let me know in the comment if this is still too high. So we're going to use the 10 billion and then we're going to divide it with the current market capitalization of 153.8. Then we're going to get the free cash flow yield for 2027. So this assumption would give us a yield of 6.5%. So this would look quite good. I think this could be an indication for undervaluation, especially if the free cash flow can continue to grow in the future. I think this company can look undervalued right now. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number, because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So what we're going to do now, we're going to take a look at the long-term debt first. The long-term debt we can see here around 4.1 billion US dollar. Then we're going to take a look at the short-term debt as well. So we can see here the short-term debt is around 1.5 billion US dollar. Then we're going to divide this with the current free cash flow. So this is around 7.87. So then we're going to get the debt to free cash flow ratio that we're looking for. So the number we would get is around 0.71. So this is a great number actually. It means in a little bit under 1 year we can repay the debt with the free cash flow. So the check here and is something we like to see. Then we can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 7.9 billion US dollar. I think this is a great amount as well. We like to see that. So overall, I think this company has a great balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. So what we're going to do now, first we're going to calculate the enterprise valuation. So this is the current market capitalization of 153.8 billion. We're going to add the debt. This is around 5.6 billion. Then we're going to take minus the cash, 7.87 billion. So this would be the enterprise valuation. We can see here this is around 151.5 billion. So then we're going to divide it with the free cash flow that we had, 7.87 billion. So then we're going to get the ratio that we're looking for. The number we would get would be around 19.25. So this looks quite good in my opinion, especially for a technology company. So the check here is under 25 and we like to see that. We can also calculate this number for 2027 with the free cash flow of 10 billion US dollar. Then we would get a different number. So this number would be around 15.15. So I think this is a great number as well. We can see if the free cash flow can increase, this number would get lower. And I think this company looks undervalued right now. The next thing you're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look, and what we can see here, yes, this company does a lot of buybacks. So we can see especially since 2022 over 2%. And in 2024, around 3%. So these are very high buybacks. This company investing a lot of money to buy back their own shares. We like to see that. So it's a check here. And I think this can help the stock price to increase again. I would like to give my conclusion about this company. So let's start with a positive. So I think we have a good revenue growth in the last 5 years. We also have a good free cash flow growth as well, something we really like to see. I think we have a very good balance sheet as well. This means a low amount of debt and a good amount of cash on hand. We have a free cash flow yield around 5.11%, which is also looking quite good, especially for a technology company. Then the enterprise valuation to free cash flow ratio around 19.25 is also looking great. So I think this can be an indication for undervaluation right now, and something I really like to see as well, that we have stock buybacks. This company buying back a lot of their shares, so this can help the stock price to increase, and I think this is important, especially if we see right now that the stock price is down around 25% in the last 6 months. So I think overall this company can be a good buy right now, but of course only if this company can continue to sell their products in the future as well and can continue to grow their free cash flow and their revenue. If you found this video helpful, don't forget to like and comment and subscribe for more content.